Hello, class. Welcome to this recap of Chapter 5, 6, and 7 of Fundamentals of Corporate Finance, where we were shown how to analyze a bond valuation and the interest rate impact on it. So here we have a case that we have to solve. So which bond here will be traded at a higher price in the market? So both bonds, A and B, have the same credit rating per value and coupon rate, but bond A has 30 years to maturity, while bond B has only 5 years to maturity. So here, bond prices and time to maturity are given identical coupon rates and per values. So bond A, the one of 30 years, will trade at a higher price than bond B, which trades in 5 years. So if interest rates fall below the coupon rate because its longer maturity means that more coupon payments at the higher rate. So conversely, if interest rates rises above the coupon rate, bond A will experience a greater price decline due to its no longer duration. So the present value of cash flows, what is this? So since bond A has more years of coupon payments, its total cash flow is more sensitive to changes in interest rates. So compared to bond B, the higher duration means that bond A is more valuable in a lower rate environment, but riskier in a rising rate environment. So what happens to the market price of each bond if interest rates goes up? So bond prices and interest rates have an inverse relationship. Okay, so here we have the formula, and we have that P stands for price of bond, C is coupon payment, FB face of value, R is the market interest rate, and T is the years to maturity. So if interest rates increases, both bonds will decline in price because the present value of future cash flows becomes lower. However, bond A, the one of 30 years, will experience a larger price decline than bond B, the one of 5 years, because its longer duration amplifies the effect of discounting. Okay, so here, which bond has a higher percentage price change if interest rates go up? So bond A, 30 years, will experience a higher percentage price change than bond B, the one of 5 years. This is due to duration, which measures the sensitivity of a bond's price to interest rate changes. Longer duration bonds react more sharply to rate changes. So here we have a numerical example. Let's assume that both bonds have coupon rate of 6% paid annually. Per value, it's 1,000, and current market interest rate is 6%. So both trade at a par. And now let's suppose interest rates rise to 8%. Using the present value formula that I previously showed here, we're gonna see that for bond B, 5 years maturity, we're gonna get 933.76. The present value here, if all coupons have a present value of about 751.57 and the face value sum is about 751.57 too. So here, what is the percentage change in price? We have shown bond B is minus 6.62% and bond A is minus 24.84%. Since bond A, the one of 30 years, experiences a much larger percentage price change, it is more interest rate sensitive than bond B. So the conclusion here is that bond A trades at a higher price initially due to its longer cash flow stream. When interest rates rise, both bonds decline in price, but bond A experiences a much larger price drop. So investors concerned about interest rate risk should prefer shorter term bonds like bond B to minimize volatility. These are references, and thank you for being here. See you next time.